Good morning, everybody. And welcome. Just going to allow 30 seconds or a minute for people to join and enter the webinar. Yeah, so that seems to be happening, so that's good. So good morning, everybody, and thank you for joining us. We are today, the purpose of today really is probably after the most hyped budget in history, just to try and drill down into the key takeaways for everybody, how it's impacting on their finances, investments and pensions, and also offer a few thoughts and strategies to try and mitigate the impact of the extensive tax rises that have been announced in the budget. If you do have any questions, please can you click on the Q&A at the bottom and we'll pick those up at the end. Obviously, as always, if you want to talk individually and look into more detail, just contact us and we'll happily do that separately. You will all be sent a copy of the video of this presentation and the slides in the next couple of days. So first slide, please. So the major issue for this budget, which has been very much publicised, is what's known as fiscal drag. It's been going on for 4 years now, and it's been extended for another 6 years. However it's dressed up, this is a serious tax rise and will have major implications on any taxpayer in the UK. We have earnings rising at 4.8% at the moment. So all these earnings are going to be taxable over the thresholds, also minimum wages going up. And this is expected to raise over £8 billion for the Treasury in the next few years. But we're going to have more pensioners paying tax on the state pension. And another major factor is the inheritance tax that will be raised for the revenue, with the number of estates being liable for inheritance tax doubling in the next few years. So inheritance tax, which used to be sadly an issue just for the very wealthy, is now going to be mainstream tax affecting an awful lot more people. And we'll go on to explain a little more in a minute. Next, please. Other issues from the budget. There has been lots of tweaking of various issues. It was described as a smorgasbord budget. Also has been described as a Klarna budget through the sort of deferral of the tax impact. But some main headlines, which we'll explain a bit more in a minute. Salary sacrifice, it's going to be a big tax raiser for the Treasury. From April 29, that's going to be capped at 2,000. Dividend tax is going up from next year by 2%. It'll affect a lot of equity investors and also affect a lot of business owners. Savings and rental income on deposits and property from April 27 going up by 2%. Cash ISA limits are changing, not as bad as was speculated, but there are changes which people need to be aware of and plan around. Finally, the much feared mansion tax was introduced at 2,500 for properties over 2 million, going up to 7,500 for properties over 5 million. Some consider this could be the thin end of the wedge, and the relatively modest tax charges will only prove to increase in the future once they become accepted as part of the normal tax framework. And finally, we've had lots of tax incentives to invest into EVs and hybrid cars over recent years. Of course, their use is meaning that fuel duty is decreasing. So from 2028, we're going to be paying per mile for EVs and hybrids. It does seem particularly unfair on hybrids, who will have to pay both the fuel duty in some cases and also the pay per mile. Again, feared to be the thin end of the wedge and the way forward as cars become less reliant going forward on fossil fuels. Next, please. Fiscal drag again. Sorry to revert back to this, but can't emphasize enough that the 12,500 personal allowance, where you can earn tax-free every year, that would have been nearly 16,000 if it hadn't been frozen 4 years ago. And the impact of minimum wage, pay increases, it's going to mean everybody's tax is going up. The worst case, the worst affected are those going to be earning about 50 to 54,000, especially if they've got student loans. Their tax liability is going to increase considerably. Again, down to this fiscal drag that a lot of people don't fully appreciate the impact of, but it's by far the biggest tax raiser for the Treasury in this budget. Next, please. We'll go on to explain a little more later on in the presentation. Pension contributions are still a major factor in mitigating the budget impact. Although speculated, the tax relief hasn't been amended. There's no lifetime allowance, so you can all at least build up £1 million pension fund. You can still take at least 25% tax-free cash and have up to 45% tax relief. So pensions should be number one on your agenda if you're pre-retirement, obviously, and you've got the earnings to support it. And again, we'll explain a little more in the future on that. Employers have been hit hard with minimum wage going up, the salary sacrifice impact in the next few years. That's another NI cost potentially for employers. And obviously the frozen tax thresholds will also have an impact. If any of your income derives from dividends, property or savings, you're going to start paying 2% extra soon. There are ways to reduce that impact and change your finances accordingly. Next slide, please. Inheritance tax. As I say, this is going to sadly become a mainstream tax for many families rather than the preserve of the very wealthy. Mainly as a result of pensions being brought into the equation from April 2027. All pensions, well, majority of pensions will have to be disclosed on probate forms and tax payable accordingly. So that's a big change. It's going to affect a massive proportion of clients. Again, there are strategies to mitigate the impact of that, and actually strategies to use your pension fund to reduce your inheritance tax or solve the liability. Again, we're more than happy to explain that to you. Business owners. Business owners up to last year were able to pass on all their shares in a trading business to their family on second death without tax liability. That's a massive difference now. You're only able to pass up to £1 million per shareholder in a trading business, the balance being taxed at 20%. Business owners are going to have to plan for this problem now, whereas it wasn't a concern beforehand. But similar to farmers, they could have cash flow problems in the event of a death of a shareholder, that they're going to have to pay an inheritance tax bill. They need to plan for that liability. Again, we can offer solutions and advice on that. One minor change in the budget that was somewhat pleasing was the fact that they will now allow £1 million per individual to pass between man and wife. So a married couple as shareholders or joint landowners can have 2 million between them. Some concession, quite a small one for bigger properties and business owners, but it is nonetheless something that you can use as part of your mitigation strategy. As I've said earlier, there are, in many ways, inheritance tax still is a voluntary tax, and there still are a very wide range of solutions, strategies, and if you allow enough time, take the right advice and review it regularly, a lot of inheritance tax can be eliminated or at least reduced. There's lots of vehicles out there which are Inland Revenue approved, trusts, inheritance tax schemes, life assurance policies, or even family investment companies. All these are form regular parts of recommendations that we offer to clients. If you want an individual review on the inheritance tax, we're more than happy to do that and offer you bespoke solutions for you to consider. At that point, I'm going to hand over to my colleague Anthony Ward, who's going to pick up and go through the major changes to other aspects, pensions, ISAs, etc. So over to you, Anthony.
Thank you, Chris. Good morning, everybody. Thanks for attending. As Chris mentioned there, I'll start off with the pensions. Despite all the mass media coverage, the mass speculation, the hysteria, I would say, and also the billions of pounds that have been taken out of people's pension funds, there were no specific changes to the main points of pensions. In that, the tax-free cash rules, it's still going to be at least 25% for people in their private pensions. There is a little anomaly in the fact the absolute maximum, unless people have got protections, which is possibly a conversation for another day, is 268,275. And in case you're wondering, that's 25% of 1,073,000. So people at this moment in time can still save into their pension towards a significant sum that will be tax-free. And there were no changes to this, which was welcomed, but also it's certainly created an awful lot of confusion and created an awful lot of work for people. And there are now quite a lot of people out there sitting on piles of tax-free cash they withdrew, wondering what I'm going to do with it, because if they're not savvy enough, they could end up paying tax on it through the income tax rises in savings. There's been no changes to contribution limits, thankfully, other than salary sacrifice, which I'll come on to, but the actual overall maximum contributions into pensions haven't changed. So that provides them and means they are still an extremely valuable savings vehicle for retirement. And remember, pensions were always intended to be the savings vehicle for a person and their family when they no longer work and they are in retirement. So the fact that contribution limits have been left alone is welcome, and people will hopefully, as a result of the impending tax changes and some of the comments we're about to make, will consider paying more into their pensions, because very, very few people ever regret doing that in the long run. There's been no change to the lifetime allowance rules. Again, quite welcome. Obviously muted. Lots of people they talk about who would be affected. Most of those people who would be affected by lifetime allowance rules, ironically, would be civil servants or people working in the NHS, etc. So there's been no changes to that whatsoever, which is welcome, but it still provides what we have got is a known framework in which we can help clients plan for the future. If we could go to the next slide, please. As I mentioned, and as Chris mentioned, the salary sacrifice feature of pensions, which has proved extremely popular, which has seen something like nearly 50% of company pension schemes and employer pension schemes set up on this basis in the last few years, is going to be capped at £2,000. Now, that doesn't happen until April 2029. So there's still 3 and a bit tax years worth of salary sacrifice contributions that people can consider taking advantage of, and if they're in a position to do so, make hay while the sun shines. Because if you don't take advantage of it at the moment, it really is worth considering what the actual savings that you make both on NI and on income tax by this valuable route. However, still, even with it capped at £2,000, it will be valuable thereafter, and pension contributions will still be a very tax efficient means of saving for retirement. It does mean, and the impact will be another national insurance hike for employers, because at the moment, anything under the salary sacrifice, the employer could save on the national insurance element. However, from April 2029, employers will no longer have that feature in excess of £2,000. So the national insurance bill again will be going up for employers as it stands. And we expect to be talking to we are talking to our business owners and their clients and looking at how we can mitigate this, or what options they've got going forward or planning for in the run up to this change in April 29. As I said, as Chris has said, and as we will always say, pensions remain one of the most, if not the most, tax efficient method of saving for retirement income. The tax relief, you are still getting tax relief, be that basic rate tax relief, high rate tax relief, or additional rate tax relief on contributions into your pension. Your employer can still make pension contributions without it being taxable. The exception, the rules on salary sacrifice are specific rules, but it still remains an extremely tax efficient method of saving for retirement that you do not experience with other savings vehicles which people are looking to accumulate for that point when they no longer work, or they look to reduce their working time. And so the bigger the pot and the more you can save into it and afford to save into it, the better off you will be. IHT, inheritance tax, from April 27, as we probably all know, or probably made aware of, from that date, people's private pension funds will form part of the value of their estate for inheritance tax purposes. And this is where, referring back to the previous slides, where 1 in 4 families or estates will be liable to IHT. This is where they're coming from. There's more, the number of inheritance tax families paying inheritance tax will double by 2031. And the biggest reason for this is the inclusion of pensions in a person's estate from April 27. So there are strategies that we're talking to with our clients who have pensions, who have previously viewed them as a very useful way of passing on wealth. It's sort of like flipped on its head a bit, but there are solutions to help where your pension could actually help reduce your estate, whereas people are now looking to draw on their pensions, be it from an income perspective or even the tax-free lump sum, as a means of living off, giving away, and leaving other capital. But if we can we'll come on to a bit more about that in a short while. But please do not forget that if we're thinking about inheritance tax, pensions will form part of a person's estate from April 2077. Next slide, please. The ISA rules are changing. A hell of a lot of coverage about this, possibly slightly behind how much coverage there was on pensions and the possible rule changes there. However, as we said earlier, and Chris said earlier, the rule changes were not as dramatic as had been rumoured or leaked, as seems to have been the case, where at one time it was thought the cash ISAs might be abolished altogether, or the allowance may reduce only down to £4,000. What we now know is from April 27, so still another tax year or so away, but you've also got this tax year, the cash limit for an ISA allowance will be £12,000 for those under 65. Anybody over 65 is going to be unaffected. But it's still the fact that the £20,000 overall ISA limit is in place. It's not been increased, but it's certainly not been reduced. So in practice, somebody who's particularly keen on holding cash, although you would question that going forward as a sensible long-term strategy, they could have £12,000 in cash and £8,000 in a stocks and shares ISA. The general hope here is that the government sees more and more people invest, which they believe is better for the economy, but also for overall for people, help people save for retirement rather than leave it in cash. But it is going to have an impact for those under the age of 65. But it's something you need to be aware of, and we've already seen a vast uptake in people looking to use their cash ISA allowance whilst the 20,000 limit remains. And also there's arguably a window of opportunity while interest rates remain at current levels. It's still possible to get 4 and a bit percent on cash. That won't always be the case. If there is a rate cut in December, then savings rates will come down. And if they accelerate as they're predicted to do in next year, then say the return on savings will become even less. The lifetime ISA, there's not been as much coverage about this, but the lifetime ISA or the LISA is being replaced. This has been very popular for younger clients or children of our clients looking to save towards their first house deposit, etc. All the government have said for now is that the lifetime ISA will be replaced, and we've said there to be advised. It's under consultation. They are looking to bring something in similar. Quite what the rationale is, we don't fully know, but it's certainly a case of it still remains an option at the moment. So we'd encourage people to use it, but it is going to be replaced at some time in the future. Hopefully in the not too distant future, we'll be able to say or provide clarification of what it will be. One of the things that we think as a result of the ISA rules changing and the reduction in the amount that can go into cash, particularly for those under the age of 65 and possibly, in the younger people looking to start saving, is the fact this actually people could be better off for this rule change, because over the longer term, over the medium and longer term, cash does tend to underperform other investment formats such as stocks and shares and other vehicles. So it actually could be good news. And there is plenty of research out there to show you, if you'd have put £1,000 or $1,000 in cash 20, 30 years ago, how much better off you'd have been had you invested it. But as with everything with investments, the value can rise and fall, and past performance is no guarantee to future returns. But we do believe that this could be a positive for people looking to save for the future. Next slide, please. Yep, the tax rates on the savings, dividends and rental income are going up. The rental income was widely, if you like, widely leaked that there were going to be some changes here. They didn't bring in national insurance, as one of the rumours had suggested, but what they are going to do is that people on their rental income will face extra tax when it is deriving from income, but also that applies to their savings and any income derived from dividends. From April 26 is when the tax on dividends will increase, and that's going up by 2%. However, we don't quite know the wisdom for this, but from April 26, it's only the basic rate of dividend tax that's going up to 10.75 from its current 8.75, and then the higher rate of dividend tax is going up from 33.75 to 35.75. The additional rate remains at 39.35%. So you can look at those and you can still see that those rates of tax are still lower than they would be for income tax, but they are going up. And this will have a big impact for an awful lot of people who've got investments and business owners who reward themselves typically via way of dividends. We can only, one of the suggestions is that the reason why they've only done the basic rate and the higher rate is the fact that that's where most people sit within the tax paying public. So they believe that they're going to catch an awful, more than enough people via that. But as with everything, as you'll come up, we'll hear, there are always some solutions to try and mitigate the effects of this. The rate of income tax on your savings and any property income that you have will be increasing but not until April 2027. Now, that's going to be going up where the basic rate of tax on savings income or any rental income will be 22p or 42p for the higher rate, and then 47 pence for the additional rate taxpayers. As we mentioned, it's going to include rental income for landlords, and there has already been an increase in people looking to incorporate their property portfolios under a limited company to try and mitigate the impact. And we will possibly see this increase, or certainly for people looking to consider starting a property portfolio, it may be one of the things they want to consider. However, I would stress this is a conversation they should have with an accountant or their accountant, who is much better qualified to explain to them the pros and cons of incorporation. But it is certainly something that's been very popular for clients and people we deal with, and it has helped to an extent, but it may not be right for everybody. Next slide. What you can do. I think we would like to say that obviously a lot of these taxes or these extra taxes, there's a fair bit of voluntary stuff there. It is not always the government's fault that people pay more tax than they're expecting to or want to. There are some very, very valuable tax allowances that are still out there, i.e., working within the framework that we've been given. We are where we are. For all of those cliches, it is what it is. But there are still plenty of things that people can do to mitigate the effect of the fiscal drag, which is quite dramatic when you look at the effect of thresholds being frozen or cut in real terms, on the effect that has on a person's wealth and their savings and their ability to save for the future. And we mentioned the tax allowances that are still out there. If it's for people, up to £60,000 a year can still be invested into pension for people. There's still the £20,000 ISA allowance overall. Yep, that could all be stocks and shares. It can't all be cash from April 27, but it's still a very valuable allowance. And if it's affordable, bear in mind a husband and wife, that's up to £40,000 that a couple could put into a tax-free environment each tax year. And the cumulative effect of that we see with our clients is extremely dramatic. In fact, we've got a number of clients who've consistently saved into their ISAs or even the precursor of ISAs, PEPs, every time they've been available, or ever since they've been available, sorry. And that has led to them building up an extremely valuable and significant pot of money from which they can derive an income or capital access in their later years or in retirement. Going back to the allowances, the ISA allowance of £20,000 is available for each adult individual. It's £9,000 for those under the age of 18, and it still remains. But use it or lose it by the 5th of April each year. If you don't use it by the 5th of April, that's it. You can't go back and refill it or retrospectively go back and fill it. If you don't use it in a tax year, it's gone. So please consider that. If people hold too much in deposit savings accounts, we've already seen that. We're more so than ever in the last year or so. Clients have been in touch and said, "Oh, I've had a tax bill," and why have I had a tax bill? Because they're getting taxed on the amount of money they're holding on deposit, because the rates of interest have been higher. And bear in mind that as an individual, you've got up to £1,000 as a base rate taxpayer of interest that you can earn that's tax free. You've got £500 of interest that you can earn as tax free if you're a high rate taxpayer, but any interest earned in excess of that is taxable at your marginal rate. That's going to be going up, remember, from April 27. But too much tax is being paid by people leaving too much money in deposit savings, not using their ISA allowance or not considering the options that are out there for them, not considering pension contributions. We've already seen it with our clients and in the day-to-day job, a huge increase in the use of offshore investment bonds and indeed onshore investment bonds, and the industry as a whole has seen a huge increase and uptake in the use of onshore and offshore investment bonds to run alongside ISA. And there's a double whammy here because of the changes in capital gains tax that occurred last year, but also the ever-present fiscal drag and the effect that will happen now on savings rates as we go forward. Personal pension contributions. If you're in a position that you can make a personal contribution yourself, this can still lead to you getting tax relief, and it could even lead to income being reduced, which can often lead to a tax rebate. But again, these need to be considered in the run-up to the end of the tax year, which is still a few months away, and the 5th of April, but it will soon come around. And in fact, we intend to do a pre-end of tax year webinar, so look out for that, to remind people of the allowances that are available. But there are some considerable savings that could be made if you are in a position to make pension contributions as well. And certainly before the salary sacrifice rules come in, again, make some hay while the sun shines. What you can do, salary sacrifice rules, they don't change until April 2029. So make more use of them if you're in a position to do so. Well, certainly whilst they're there, it's going to be very, very valuable. They will still be valuable, I would stress, even with a £2,000 limit after April 2029, but they are certainly more valuable at the moment to make use of. Inheritance tax, the 7-year rule on inheritance tax, that still applies. It was rumoured, again, that it could be extended to 10 years or 14 years even, or even reduced. It still applies. So that basically means if you make a gift to somebody, your family, somebody in your family, as a means of reducing your estate, you've got to live for 7 years for that to be outside of your estate. Exceptions occur if you've made that gift to charity or anything like that, but the 7-year rule applies. So the sooner you consider your options or understand your options, the better. Because the one thing about the 7-year rule we find, which is the same with everybody we deal with, everybody's getting older. And I'm sure if you were to think back 7 years, you would think, where has that time gone? Because it's certainly flown. Inheritance tax, similar theme. The sooner you start the clock ticking on any 7-year clock, the better. There are other options that don't require a 7-year rule. That's something we can talk about, and we do talk about and engage with clients, and we're happy to use. But the sooner you start that clock ticking, the better, because, as we've mentioned before, inheritance tax really is often a voluntary tax, and the revenue find it such an easy tax to collect because so many people haven't done the planning or haven't considered their options, and by the time it becomes payable, it's too late. But please consider the options and understand what your options are. And in fact, what we're doing for a number of clients is a budget impact report specifically around the inheritance tax and how they're exposed to it. And it's been quite enlightening. And we've certainly seen more engagement with clients since Labour government got elected. But it is certainly a thing that people can mitigate and thus mean that more of their wealth is passed on to their family and the people they'd intended rather than His Majesty's government. The other thing about inheritance tax, a rule that's often overlooked and what people are using their pensions for or considering using their pensions for or drawing from them, is the surplus income rules, is a gift from surplus income. There's some very strict rules that apply for this to qualify for inheritance tax relief, but it can be a very useful means of reducing somebody's estate whilst they are alive, but also helping their family and more in directing their wealth to the people they want. But again, you need to consider the options carefully. And it is not simply a case of thinking, oh, I'm giving away the income. It's got to be surplus income. But that's, again, I would suggest a conversation for another day, which we're happy to talk through with people. Life assurance. It's always been there. It's always been an option. It's become ever more popular because in an awful lot of cases, it's a very cost efficient way when you consider what could be insured or a family could insure the estate's liability for compared to what they would lose if the insurance wasn't in place. Written properly, it can really help preserve wealth within the family, which is what most people intend to do as they've accumulated the wealth over the years. And we're certainly seeing more use of fix or family investment companies, inheritance tax schemes where the typical 7-year rule doesn't apply. It's actually a 2-year rule. So that's extremely popular. The use of whole of life terms of policies there, insurance, and of course, trusts. Trusts need to be entered into with a full level of understanding of what the implications are. We suggest that people also engage with their lawyers, or we can put them in touch with lawyers because it's a very, once money's in a trust, it's tied up, but it can be very, very effective. And it's certainly an effective means over time of helping retain wealth within the family, which is, as I said, where most people intend it to stay beyond their days. Next slide, please, Harvey. So brings us quite nicely onto the question section. If we have any, do we have any? Yeah, we've got.
Yeah, there's a few come through. I'll just pick up the first couple. Somebody's asked, were there any changes to capital gains tax, which was widely speculated in the media for the budget? Yes, it was widely speculated, and at an extreme, people were concerned that capital gains tax would be moved in line with income tax. There were no changes whatsoever in this recent budget to capital gains tax, which was quite surprising. It was also widely rumoured that the exemption of capital gains tax on death may be reviewed, but again, that nothing happened there. Of course, in recent years and budgets, The capital gains tax allowance has come down considerably, and the rates have gone up. So it's already been changed quite radically, which has impacted on our recommendations to clients when they're investing. And also it's had quite a radical impact on business owners, or it will do, because entrepreneurs allowance and such business-based issues, they've been massively reduced. So capital gains tax has had a hard time in recent years, but there was no actual specific changes in the budget a couple of weeks ago. Another question is, somebody's asking that we referred to offshore bonds. They're asking, what are these and where are they invested? Offshore bonds is very much interlinked with capital gains tax because of the increasing rates and reduction in allowances and capital gains tax. Offshore bonds have proved to be very popular in recent years and expected to increase in popularity. You're able effectively as a UK taxpayer to invest your money offshore, somewhere like the Isle of Man typically, and you're not impacted on returns, your investment returns aren't affected by UK tax whilst the money's in the Isle of Man. You can assign the funds out to children or other relatives if you want to do so, and you can take 5% per annum income with no immediate tax liability. So in an environment where we've got UK tax increasing year on, year out, understandably, these are proving very popular, where investors want to defer the tax, hopefully to a future date when the tax environment is a lot kinder than it is at the moment. Anthony, do you want to pick up? I think there's another couple of questions coming.
We've had one question here about with regards to ISAs, stocks and shares ISAs, and how do we recommend that people who want to have a cash holding as part of their portfolio manage this, given the changes coming up? Clearly, cash has always been a very important part of somebody's portfolio and how they manage their liquidity or their finances. What we do know is that from April 27, and if you're under 65, up to £12,000 can still be invested into cash ISA, and where appropriate, we feel, and obviously that will obviously still be viable. We work with a lot of clients where there's lots of, we look after quite a few of their cash, a lot of their cash ISAs. So it's ideally, absolutely, it's still part of a portfolio, and given the fact that it is okay, it's not 20,000, but somebody can still take advantage of the cash ISA route. What I would say is that if it's possible, it's a husband and wife, then there's a potential there between them to have £24,000 as part of their overall portfolio under ISA, under the ISA wrapper for cash. But we believe that there will be methods. We'll also see, I think, coming on, we mentioned there about the use of investment bonds and offshore or onshore bonds. We possibly see some innovation coming through there. Indeed, offshore bonds, people can hold cash accounts under those, although there are the interest rates that get paid are slightly different because there are some product fees. But we do believe, as we do at the moment, that we will be able to innovate and people will still be able to have a healthy cash holding as part of their portfolio, because if we're honest, at certain times in life, it's the right thing to do. However, what we have to say at the moment is tread carefully, because you may have read in the press, and certainly the boss of AJ Bell has mentioned in the FT this morning, that the proposed rules on how people will be taxed for holding too much cash under their ISAs are bonkers. So let's wait and see what some of the feedback from the government or the consultations come back. But that's how we would look to obviously discuss with the client how much cash they feel would be appropriate to hold, and certainly the ISA providers will be able to work. It's possible, as I said, to hold a stocks and shares ISA for up to 8,000 and 12,000 in just a cash ISA. So hopefully that answers the question. But please, if you'd like anything a bit more specific, drop us a line and we're more than happy to pick that up afterwards. couple of other questions we had. Can I transfer a stocks and shares ISA to a cash ISA? Well, you can at the moment, but from April 27, you won't be able to, unless you're over 65. So those are the rules at the moment there. One other question. I start a new job in January, and the pension scheme I'm being offered is going to be on a salary sacrifice. Is that still a good thing? Yes, absolutely. It's still a good thing because the rules on salary sacrifice are still available until are still very attractive up until the April of 2029. So we would certainly suggest that there's no reason there why somebody shouldn't join their employer's pension scheme and take advantage of salary sacrifice, if in this instance starting in January or any time up until 2029. In fact, at any point, please do not consider not joining your employer's pension scheme when you're offered it, because it's a very valuable source of savings.
Yeah, I'll just pick up just a couple more come in. Somebody's asked, are there any changes to the rules covering the use of spouses, unused tax allowances? We're not aware of any. And it's, one thing I would say, I'm sure it's an issue if it's to do with allocating earnings. For example, that's an issue to take your accountant's advice, but any earnings that are allocated to a spouse, for example, they've got to be considered reasonable and reflect the amount of time and effort input. But in regards to investing money on behalf of spouses, then we're not aware of any changes there. Final question is regarding stocks and shares.
Just wondering that the unused personal allowance, there's no, I've not seen and didn't see anything at all where it's not possible for the main the higher taxpayer, as it were, to not be able to take advantage of a spouse's unused element. So
and the final question in regards to stocks and shares ISAs, somebody's asking, how do you recommend people who want to have a cash holding as part of their portfolio manage this, given the new charges due on interest and cash equivalents held within them? So obviously the limit on cash ISAs has come down, but as far as we're aware, the taxation treatment remains the same, that there is no tax on cash ISAs. There are other alternatives to cash, which are sort of lower risk, smooth managed funds, which can be held within ISAs, which will go above the 12,000 limit. Also, we discussed earlier offshore bonds. They can hold cash funds, which again are very tax efficient, outside the remit of the UK tax whilst money's held offshore. So again, we don't see any major changes or challenges on that front. And I think that's the end of the questions now. So just like to close by thanking everyone for your time this morning. Hopefully you found it informative and of use. If you do have any individual questions, our emails are there. Give us a ring or email us. As I mentioned, we're happy to provide budget impact reports for any of your clients or yourself individually to assess your circumstances, confirm any changes in the impact, and also how we feel you can mitigate and improve your tax position. So thanks again. Have a good day, and hopefully we're in contact again soon.
Thank you very much. Have a good day, everybody. Thank you.
Goodbye.
Bye.